Discover how Singapore REITs could bounce back in 2025, potentially turning your property investments from red to green as interest rates shift. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 800,000 reads. I've produced over 600 videos with more than 280,000 watch hours as of November 2024. I also focus on regional and world economy topics. Let's dive into something that's been keeping many Singapore investors up at night, S-REITs. If you've been holding on to REITs, you know the past year hasn't been easy. The high interest rate environment has put pressure on REIT valuations, affecting both share prices and dividend yields. But here's the good news. 2025 might be the year things turn around, and I'll explain exactly why. First up, let's talk about interest rates. Think of interest rates like the price of money. When they go down, REITs can borrow money more cheaply. It's like getting a better deal on your home loan. Market experts predict interest rates will drop in 2025. This means REITs will pay less for their loans, which leaves more money for us as dividends. Let me put this in perspective. When interest rates drop by just 1%, a REIT with $1 billion in debt could save $10 million in interest payments annually. That's money that could flow back to investors. Quick engagement check. Have you noticed how your REIT dividends changed when interest rates went up? Drop a comment below with your experience. Now, here's something exciting. Not all REIT sectors are created equal. Industrial and hospitality REITs are showing some real promise. Industrial REITs benefit from Singapore's strong manufacturing sector and the rise of e-commerce. The demand for warehouse space and data centers continues to grow. Meanwhile, our hospitality sector is booming with tourist numbers hitting new highs. Singapore's tourism board projects visitor arrivals to reach pre-pandemic levels by 2025, which is great news for hospitality REITs. Let me break this down with a real example. Look at Ascenda's REIT. During past periods when interest rates fell, they didn't just sit still. They kept their buildings full of tenants and even bought new properties. Their occupancy rate stayed above 90%, showing strong demand for their spaces. When their loan costs went down, guess what happened? More money flowed to investors through higher DPU, that's distribution per unit, basically your dividends. They even managed to expand their portfolio during these periods, acquiring quality assets at attractive prices. Here's where it gets interesting. Market sentiment. When interest rates drop, investors typically get more excited about REITs. Why? Because REITs start looking more attractive compared to bonds and fixed deposits. Think of it like a seesaw. When interest rates go down, REIT prices often go up. This creates a potential double win situation. Higher dividends from lower interest costs, plus capital gains from price appreciation. Speaking of which, if you're enjoying this analysis, hit that like button and subscribe for more Singapore-focused investment content. But here's the crucial part, picking the right REITs. You can't just throw a dart and hope for the best. Each sector responds differently to market changes. Some REITs might bounce back faster than others. That's why understanding sector performance is key. Look at factors like tenant mix, lease expiry profiles, and debt maturity schedules. These details matter more than ever in today's market. Let's dive deeper into some numbers. The S-REIT market has been under pressure from high interest rates, with the FTSE REIT index showing significant volatility. But analysts expect this pressure to ease in 2025. We're seeing signs of recovery in property valuations, especially in industrial and hospitality segments. Cap rates are starting to stabilize, and rental reversions are turning positive in several sectors. These aren't just random predictions, they're based on market trends and economic indicators. Now, I need to address the elephant in the room, risks and considerations. Yes, the outlook seems positive, but we need to be smart about this. Global economic conditions can change quickly. A recession could impact tenant demand. Different REIT sectors might react differently to market changes. And most importantly, interest rate predictions aren't guarantees. Some REITs might face refinancing challenges even in a lower rate environment. Here's my practical advice. First, don't put all your eggs in one basket. Spread your investments across different REIT sectors. Second, look at each REIT's debt levels and refinancing needs. Focus on REITs with staggered debt maturities and strong balance sheets. Third, consider the location and quality of their properties. Premium properties in prime locations tend to maintain occupancy better during downturns. Let's talk about specific metrics to watch. Look for REITs with A. Aggregate leverage below 40%. B. High portfolio occupancy rates above 95%. C. Long weighted average lease expiry. WALE. D. Strong sponsor backing. Before we wrap up, here's your action plan. 1. Review your current REIT holdings. 2. Check their debt levels and refinancing schedules. 3. Consider adding exposure to industrial and hospitality sectors. 4. Keep an eye on interest rate movements. If you found this helpful, you'll love my previous video on REIT losses, stop the bleed. Remember, investing is a marathon, not a sprint. While 2025 looks promising for S-rates, always invest based on your own research and risk tolerance. Stay tuned for more updates as we track these developments together. That's all for today, friends. Don't forget to like, subscribe, and hit that notification bell to stay updated on Singapore investment opportunities. See you in the next video.